What should we be looking for on Friday morning?
Well, I don't think the big bank earnings will be that exciting. I think you'll see some structural progress when it comes to cost control. Credit quality is still good, and capital return is the highest in history. On the other hand, revenues should be a little bit soft. So if you're looking for that, extra excitement because revenues are accelerating in a big way, you might be disappointed. If you're a long-term investor, though, and you want to see steady, sustainable progress, then you should be pleased.
So what happened to net interest margin? There wasn't a time too long ago when we heard, boy, if you just get those interest rates up some, we're going to make a lot of money. What happened to that?
Well, look, I think there's a lot of short-termism when it comes to the banks. Everybody's looking at some of these metrics, but net interest margin is the difference between what banks collect on their loans and what they pay on deposits. And that net interest margin declined, the biggest decline in 80 years up to a couple years ago, and now it's been increasing, but that rate of the increase is a little bit less as banks pay more in deposits, and the loan repricing isn't quite as much as some had thought.
So you think that this is going to be the time in deposit beta? We're finally going to see it all start to happen?
You're getting very technical with me here, Alex.
But no, okay, but let's broaden it out.
I'll address that.
Okay.
Yeah. So look, deposit beta refers to how much do bank deposits go up for every increase in the interest rate environment. And so those deposit betas are increasing. So as the Fed continues to raise interest rates, the rates that you get on your bank deposits has gone up. Having said that, as long as that, quote, deposit beta is under 1, it's still generally good. And why is the deposit beta increasing? Because we think the economy is generally strong. So you have some other positives like credit quality. The quality of bank loans remains excellent, and that's the most important factor for investing in banks over the long term.
One of the banks we hear from on Friday is Goldman. There's a change at Goldman at the top with the CEO, and there are a lot of changes around him now. We even had a report this week that maybe they're going to cut back some on Marcus. What do you expect there? Is this moving faster than you would have anticipated?
Well, Goldman reports in the next week, and I did read the Bloomberg article saying that Goldman Sachs is not pushing Marcus as aggressively. As you know, that's the consumer lending outfit. For 149 years at Goldman Sachs, they've served institutional wholesale customers, and now Goldman Sachs is expanding to the person on the street. The issue with Goldman Sachs Marcus, though, is the quality of those consumer loans is a little bit less than your typical loan. It's unsecured credit, so that entails more risk. We don't think Goldman was ever going to reach its targets over the next 3 years, and now you have a new CEO come in, David Solomon. He's probably like, this is us talking, not the company, but we kind of think the new CEO would not want to own those targets for Marcus, so you take over, pull back the targets. It's definitely a long-term strategy, but in the short term, they're going to be more tactical.
So we know that you're a bull for banks for the long term, right? So you're going to be on the call with these guys. What's going to be the question you need to know to sort of back up your thesis?
Well, I think the question that the market wants to hear is, what is the outlook for growth? So the bank earnings might be a little ho-hum. The excitement will be in the question and answer session and in the outlook. So what's the impact of the higher interest rates? Is loan growth picking up? Are you seeing extra animal spirits? What's the outlook for capital markets? What's the kind of follow through from the tax cuts that we've seen, and we haven't seen that follow through as much. So that's why the banks have been not the best performers recently. For our thesis, our 3-year thesis, what we want to see is this cost control continuing? What's the rate of branch closures? How is technology driving greater efficiency? What is the outlook for credit quality? And this cap return is the highest in history. Is that continuing?
Mike, I don't want to let you go without talking about something you really care a lot about. This is a proxy advisory rule changes. There's a legislation pending in Congress. The SEC is taking a look at it. A lot of our audience probably doesn't know what this is, but basically there's a proposal that there be registration for proxy advisors and that they have to disclose any conflicts of interest they have, and also make sure that they disclose the base of research. What's wrong with that? That sounds kind of reasonable.
Well, it's called the Corporate Governance Reform Act, and the
sounds good.
Sounds great, right? But so the way it works is these proxy advisory firms, they conduct research, they issue recommendations. Investors sometimes listen to them, and then sometimes you have, votes. And the first thing is, of all the shareholder proposals this year, there's been 873. How many have been binding? 0. So at the end of the day, none of this is binding. But the issue is the proxy advisors would conduct their research, and let's take Citigroup. Does it pass the Citigroup test? If ISS or Glass Lewis, or one of these proxy advisory firms, wants to conduct research on Citigroup, and issue a recommendation. It could be on Citi's CEO pay. Yeah. It could be on the chair CEO split. It could be on forming a shareholder governance committee to create more value. Right. They have to show that research to Citigroup before releasing it.
But Mike, in a nutshell, the whole basis of securities regulation is disclosure. The companies, the public companies have to disclose. That's what the SEC requires. Why not require the proxy advisors to disclose things like conflict of interest? Why isn't that just good sense?
Disclosure is needed, but also welcome to financial services. You need to have the adequate firewalls. You need to have disclosure. So let's make sure that all participants have those firewalls and disclosure. When it comes to having to show your research to companies before releasing it, I've seen enough of that in my 3 decades, the backlash that you can have. No way. This is an easy call. That's not corporate governance. If you want to talk corporate governance, I'll talk corporate governance. We can. I'll give you a long list of things. I would take the opposite side of this.
Okay, we'll see whether this proposal goes anywhere, by the way.
All right, Mike Mayo, Wells Fargo Securities. Good to get your perspective. Thank you so much.
Wait, I brought you a gift.
Okay.
So
we got gifts.
On that last point.
I love shareholders.
I love shareholders.
That's a
good gift. Okay.
Mike, thanks. Good to see you.